The entire housing market is about to collapse. That might sound like a bold claim, but it's backed by irrefutable evidence. Almost every housing indicator is showing terrifying signals. We're talking about record low mortgage applications, skyrocketing evictions, low consumer confidence, bankruptcies, and a home building bubble. The housing market was built on pillars of sand, and all of those pillars are about to crumble. Within the next 12 months, the world is going to wake up to the complete disintegration of the housing market. At the end of this video, I'll cover exactly which cities will experience the most pain from the impending housing crisis. According to the National Association of Home Builders, the US is already in a housing recession. Because of the massive appreciation of home prices in the past decade, home building has taken off in a bubble-like fashion. New privately owned houses under construction are at an all-time high. That's right, an all-time high. Over 1.6 million housing units are under construction, which is 12.5% higher than that of the 2008 housing bubble. Hundreds of thousands of houses are going to go on sale in the next few months, and there are not going to be any buyers. Housing sales are currently plummeting month after month. New single-family sales have dropped to a 5-year low of only 500 million units per year. So not only do we have a record high supply, but also shrinking demand. According to consumer confidence surveys, US citizens no longer believe in elevated housing prices. The Wells Fargo index has dropped for 8 consecutive months to just 49 out of 100. That's a frightening trend that puts housing confidence on track to levels similar to the 2008 recession. Throughout this video, I'm going to be ranking every indicator from 1 to 10 on the top right of the screen. Make sure to stick around to the end of the video to see my final assessment. The Wells Fargo index is not the only indicator showing an alarming trend. Surveys nationwide are all pointing toward the fact that consumer confidence is extremely low. The horrifying consumer sentiment is best exemplified by Fannie Mae's National Housing Market Survey. According to the survey, 79% of US citizens think it's a bad time to buy houses. On the flip side, only 17% of citizens believe it's a good time to buy houses. The difference between the two percentages is the worst that Fannie Mae has ever seen since the survey's creation in 2012. When everyone thinks that the housing market is going to crash, prices will inevitably crash. Mortgage applications are now plummeting to record lows. According to the Mortgage Bankers Association, mortgage demand has fallen to the lowest level in 22 years. One of the key reasons for low consumer confidence is rising interest rates. Because mortgage rates are rising to record heights, mortgage applications are dropping like flies. Federal Reserve Chair Jerome Powell recently remained adamant about raising interest rates at all costs. People thought that Powell would pivot and suddenly start printing money again, but Powell's recent speech at Jackson Hole shows otherwise.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation.
Powell will continue raising interest rates regardless of how much the US economy crashes. This will knock over the housing market's pillars for one reason: capitalization rates. During the past decade, institutions flooded toward the housing market to create investment products. The National Association of Realtors found that institutional buyers represented 13% of residential sales in 2021, up from just 11.8% in 2020. Firms like Blackstone have expanded into the real estate market, with billions of dollars of new housing units being acquired. The primary reason why institutions flock toward housing is because of capitalization rates, or cap rates in short form. Cap rates are calculated by taking the rental income that a property receives and dividing it by the property's market value. If a house is worth $1 million and the rental income is $40,000 per year, the cap rate would be 4%. Powell is adamant about raising rates to 4% by 2023, which puts immense pressure on the rental market. According to the CBRE Group, the average multifamily property cap rate was roughly 4.6% in the fourth quarter of 2021. This means that the average multifamily property earns 4.59% annually from rental income. As interest rates increase in the future, real estate investors will see their profit margins shrink significantly. The difference between the multifamily cap rate and the 10-year treasury yield is increasing month after month. This difference is also known as the spread, which represents the extra profit that real estate investors make from properties. If 10-year treasury yields are higher than the multifamily cap rate, then there's no reason for investors to invest in multifamily properties. This is because buying 10-year treasury bonds is as easy as clicking a button on your iPhone. On the other hand, Investing in multi-family homes is extremely labor-intensive. If clicking a button makes more money than hiring hundreds of employees to run multi-family properties, investors would just sell their properties to buy bonds. Interest rates have ranged from roughly 0 to 2.5% in the past decade. The spread was quite lucrative in the past, with landlords making a hefty profit on their properties. The 10-year treasury yield is now at over 3%, and it will likely increase to 4, 5, or even 6%. This will cause real estate investors to make less profit on their properties and possibly even start losing money. Because real estate prices increased so much, many real estate investors began taking out adjustable rate mortgages. This is going to have devastating implications. Adjustable rate mortgages, or ARM in short form, have an interest rate that fluctuates with the market interest rate. The use of ARMs has increased considerably in the past decade due to high real estate prices. ARMs work extremely well while interest rates are low. Interest rates are now going to suddenly increase to 4% by 2023, which means that those who took out ARMs are in serious trouble. As ARM rates increase over the next 12 months, profits for real estate investors will shrink dramatically. Some investors will start losing money, especially those invested in cities with low cap rates. Many investors will have no choice but to sell their properties. This is because as rates on ARMs rise in the coming months, some citizens won't be able to pay the increased interest. Once someone stops paying their mortgage payments, a foreclosure will occur within 12 months of the default. A foreclosure is when lenders repossess a house in order to sell the house and recoup their loan. A house call is a type of margin call where banks require people to deposit money to meet margin requirements. This is similar to a margin call in the stock market, where investors need to deposit money in their accounts to increase the equity to debt ratio in their portfolio. Margin calls happen when the percentage of margin exceeds a certain percentage. House calls usually occur when the price of the house drops, forcing the borrower to make up the difference through a deposit. If the borrower cannot deposit money, the lender will seize the property and sell the property via foreclosure. This brings us back to square one. Foreclosures essentially create a downward spiral of more and more foreclosures. Foreclosures lower prices, leading to margin calls, causing more foreclosures, which then drop prices even more. This will lead to more margin calls, causing more foreclosures, and the cycle continues. The number of foreclosures is up 200% year over year, which is only the start of much more to come. The number of foreclosures is still relatively low compared to the past 2 decades. With interest rates beginning to increase, foreclosures are bound to skyrocket soon. Because of the nature of my videos, I have to be wary of any government leaders illegally tracking my browsing history. Many companies are tracking every move you do on the internet to use your own information against you. Over 53 million people online have been impacted by cybercrime in the first half of this year alone. I've been fortunate enough to secure my consumer data from foreign governments and businesses by using ExpressVPN. With the click of a single button, ExpressVPN reroutes 100% of my internet traffic through their encrypted servers, making it much more difficult for anyone to steal my information and use it against me. The app is super easy to use. You literally just open it, tap this big button here, and that's it. I also love that it works on all my devices, phones, tablets, computers, even my router, so I can keep my whole family safe under one subscription. Protect yourself today from big tech companies and foreign governments stealing your data by using a trusted VPN service. Sign up now and you can get 3 months of ExpressVPN for free by visiting expressvpn.com/casgains or clicking the link in the description box down below. Thank you to ExpressVPN for sponsoring this video, and now let's get back into it. But while foreclosures are a serious concern, there's actually an even more pressing issue: evictions. Because of 2 main pain points, eviction filings are skyrocketing right now. Landlords are currently evicting people en masse, with states like Connecticut seeing a huge increase in eviction filings. The first reason for this is the US government, which banned evictions during the pandemic. Laws like the COVID-19 Tenant Relief Act prevented landlords from evicting tenants during the pandemic. The US Treasury Department also gave over $46 billion to assist tenants with their rent. In addition to all this, state governments also started their own rental relief programs. Many states also temporarily banned evictions as well. All of this help from the governments prevented evictions from happening during the pandemic. The majority of these programs have now ended, which is causing eviction filings to skyrocket. For instance, Minnesota recently ended its renter protection program on June 1st. This caused evictions to skyrocket by 50 to 80% in the following months. Other states like Maryland, Colorado, California, Virginia, and so many more have recently closed their eviction prevention programs. As a result of this, places like Maricopa County have seen their eviction filings reach record high levels. The second reason why evictions are accelerating is because rental prices are simply too high. Due to inflation in housing prices, landlords had to increase rental prices significantly. Certain cities saw their rental prices increase by 30 to 40% from pre-pandemic levels. Some tenants simply can't pay their rent anymore due to increased prices. Rent-to-income ratios have increased to a 10-year high of over 23%. This means that the average US citizen spends over 23% of their income on rent. That is incredibly high, and has forced many people to become homeless recently. Apartment retention, or the percent of tenants that resign their leases, has tanked by roughly 7% from the previous year. This is a sign of an incoming spike in evictions in the coming months. In addition to people getting evicted, new apartment leases are also dropping significantly. According to RealPage, the number of new apartment leases is quickly decelerating. So not only are existing tenants being kicked out, but the number of new tenants is also slowing down. While tenants are facing considerable pain, landlords are as well. Institutional investors are now fleeing the rental market by evicting families and selling properties. Private equity firms and other corporate landlords have reportedly filed to evict over 123,000 families nationwide. This is according to the Private Equity Stakeholder Project, a spreadsheet that tracks all evictions related to private equity firms and corporate landlords. Because cap rates are decreasing now, institutional investors have no choice but to sell their properties. For instance, Starwood Capital Group is looking to sell roughly 3,000 single-family houses worth about $1 billion. The implications of this are going to be serious for housing prices, but there's an even bigger elephant in the room: banks. Because mortgage demand is at record lows and tenants are not paying their rent, banks are losing a hefty amount of their revenue. Wells Fargo recently saw their total net income drop by 48% year over year due to shrinking mortgage demand. The bank reported that their income from mortgages fell by a staggering 79% from the previous quarter. With mortgage applications only continuing to decline, I wouldn't be surprised if Wells Fargo started losing money soon. Wells Fargo CFO Santa Massimo expressed his concerns about the mortgage crisis. He explained how it will be a challenging market in the mortgage business for the next couple of quarters as things start to stabilize and we see where the path of rates are going to go. As a result of Wells Fargo's disappointing performance, the bank began laying off staff in its mortgage division. But Wells Fargo is just one fish out of the giant pond of many banks. JP Morgan Chase recently abruptly halted share buybacks to meet their new reserve requirements. Wells Fargo, JP Morgan Chase, Bank of America, and Citibank have all seen their incomes drop by 20 to 50% in the latest quarter. The four banks are also known as the Big Four because of how large their market share is. The combined value of all four banks' assets is almost $9 trillion, which is worth roughly 45% of the entire US GDP. The amount of control that the Big Four has on the US economy is immeasurable, but some smaller banks could be just as devastating. During the real estate bubble in 2021, many mortgage lenders started giving out non-qualified mortgages, or non-QM in short form. Non-QMs are given to borrowers who can't qualify for traditional mortgage programs. Unlike traditional programs, non-QMs use alternative methods to see if borrowers are trustworthy. According to CoreLogic, the non-QM share of loans has doubled in the first 3 months of 2022 to 4%. While venture capitalists might tout non-QMs as innovative, they might as well go to the casino instead. Recent non-QM lenders are going bankrupt due to increasing interest rates. One non-QM lender named First Guarantee filed for bankruptcy earlier this summer. Once interest rates started to increase, First Guarantee's lending volume suddenly tanked. This caused the company to leave $473 million delinquent for creditors. Another non-QM lender named Sprout Mortgage suddenly closed down in July. As interest rates continue to rise in the coming months, more non-QM lenders are going to go bankrupt, creating further strain on the housing market. While forecasts for the housing market vary from person to person, most banks know that a crisis is coming. Goldman Sachs has forecasted that housing activity will decline by close to double digits in 2022 and 2023. With our final assessment at 53 out of 70, I personally think that the housing market will fall much further. I would estimate the decline in housing activity to be closer to 15 to 20% in 2023. The implications of the housing crisis are considerable because of the wealth effect. The wealth effect is an economic phenomenon where an increase in your personal net worth elevates your consumer spending. The wealth effect also works in the opposite direction. If you see a sudden drop in your net worth, you will likely spend less money. Studies have shown that the wealth effect is the most significant in the housing market rather than other assets like stocks. The National Bureau of Economic Research estimated that for every $1 change in housing wealth, citizens will spend 9 cents more in the long run. Because of the wealth effect, the incoming housing crisis will have a considerable impact on the whole US economy. With housing prices on the decline, you might be wondering whether your city's housing market is in trouble. Make sure to follow my scorecard in the next couple of minutes to see if your city is in trouble. For the sake of this video, I'm going to be tracking Las Vegas, Nevada. The first factor that we're going to be looking at is cap rates. Take a close look at this graph that shows the cap rates for various cities in the US. Cities like Los Angeles, San Jose, New York City, and Seattle have the lowest cap rates in the nation. As a result of low cap rates, these cities will feel the most pain from rising interest rates. If your city is in the blue, add 1 point to your score. Las Vegas is in the green, so my scorecard is still at 0. Another factor to look for is the level of housing starts. As mentioned earlier in this video, increased home building will cause the housing supply to be elevated. This map shows how much housing starts increased in each state at the beginning of 2022. The more yellow the state is, the bigger the crash will be. Arizona, Montana, Wyoming, and Florida are all in huge trouble. Add 2 points to the scorecard if your city is in any of those states. Nevada, Texas, Mississippi, Tennessee, and West Virginia are also contenders for a decline in housing prices. If your city is in one of the contending states, add 1 point. Another factor to be put into consideration is whether housing prices are overvalued. Moody's Analytics recently did an analysis on which cities were overvalued and undervalued. The top 20 overvalued cities are on the screen right now. If your city is on this list, add 1 point to your scorecard. The next factor to look at is rental prices. A report by Zumper recently evaluated which cities experienced the largest rent increases. Add 1 point to your scorecard if your city is on the list. The last indicator on my checklist is foreclosures, which should give a relatively accurate representation of which areas are already being hurt by rising interest rates. According to SoFi, the top 20 states on the screen had the highest foreclosure rate in July 2022. If your city is in any of these states, add 1 point to your scorecard. Any score from 0 to 2 means your city is in a relatively safe area right now. If your score is from 2 to 4, then your city is in the crash territory. Anything from 4 to 6 means that your city's housing market has an extremely high probability of collapsing. Las Vegas ended my housing market evaluation with a scorecard of 3 out of 6, which puts the city in the crash territory. Feel free to run back the video to the timestamp on the screen to go through my housing market evaluation again. Make sure to comment down below what score your city ended up with. If you enjoyed this video, make sure to hit the like button and subscribe to stay up to date on the economy. Thank you for all of your support, and I'll see you in the next one.